You're listening to the Savings Tip Jar with Dom Beattie and Denise Raywood, brought to you by Savings.com.au, your home of savings news, guides, and product comparisons. G'day, welcome to the Savings Tip Jar. Great to have your company for episode 161 of Australia's favourite receptacle-themed finance podcast as we scrounge up some savings tips, discuss the top money news and hear some expert insights. I'm Dom Beattie, the editor of Savings.com.au. Alongside me, as usual, is our senior finance journalist Denise Raywood. And this week we'll be discussing the sharp slump in home loan lending, with new data revealing loan applications in June were down 14% compared to last year. What's going on there? Also, we have a new bank in Australia, with international fintech Revolut granted a full ADI license from APRA just this week. What should we expect from them? Plus, dire warnings from Australia's peak housing construction body of how the new ban on SMSF borrowing for residential property investment will see nearly 2,500 building contracts torn up. Can't be good for housing supply, right? Then, for our Dollar Dialogue, we talk to renowned property investor, buyer's agent and author Lloyd about his new book called Set for Life, as well as his take on the current market and whether it represents a buying opportunity. Don't miss that chat. And of course, our savings tips for the week. But first, let's check in with my co-host Denise. G'day Denise, how are you?
Very well, Dom. I have read Lloyd's book, Set for Life, and I've actually liked a few of his. He's got a lot of savings and budgeting tips in there, and I thought I'd heard all of them, but I particularly liked one that he had this week, so I've pinched it for my savings tip.
Fantastic. Let's hear it then.
Okay, so I was checking them all off, as I said, and yes, you know, the standard, and heard that before. But I like this one. He said, instead of going out for drinks, which, let's face it, cost you an arm and a leg these days, he said, gradually build up a bar at home and invite people to yours for drinks. Now, it reminded me, I have a friend who bought a house and it's got a very professional looking bar inside it, you know, probably a bit old fashioned actually. It was just from that era. And instead of them tearing it out, they actually lent into it and went with it. And I have had many a brilliant cocktail at that bar. And I thought, you know, sometimes I'll buy a bottle of something, this or the other, for her for a birthday, and other people do that too when they come. So, you know, there's other people helping stock her bar. But that way you can still be social without the big hit to your finances, which, you know, can be in a few hours of just having a couple of drinks and a chat. You know, can easily cost you the price of, you know, a couple of days' groceries. So, yes, I liked the bar at home concept. I give it a big tick and thought I'd share.
Yeah, nice one. Yeah, it's an interesting one, that one, because obviously there's dangers associated with that. There's a few hairs on that. But, you know, like we sort of discussed in the pod, one of the previous episodes of the podcast, like if you are just ensuring that you're keeping your drinking just for social occasions, yes, that you could save yourself some money. So as long as you're not building the bar and then finding yourself drinking alone there every night, then it should be okay. But yeah, certainly if we're
I never have a drink on my own, Dom, so I'm okay with that.
That's a good rule to live by.
Right. Some people don't.
That is something, yeah, like I think you can listen back maybe 2 episodes before this one, I think episode 159, I talk about how, yes, this year I'm not buying those beers for myself every weekend. I'm just going to save my drinking for social occasions. But yeah, I don't think you're going to see me setting up a bar at home anytime soon. I mean, there's a bit of upfront costs with that one. So it's a solid investment initially, building up the collection of spirits. But yeah, perhaps over the long term, you make up for that in savings if you're not going out to pubs and so forth. Interesting one, that one. My savings tip, very different. Basically, and we touched on this a bit in the Savings News Roundup, which is coming up right up. But yeah, the mortgage market is pretty quiet right now, which is probably a symptom of the higher interest rates and, of course, the tax changes for property investors and the subsequent slowing property market too. But yeah, that means that if you've currently got a home loan, now could be a really good time to renegotiate your interest rate with your current lender, or consider refinancing to another lender, because home loan providers right now may be pretty desperate to secure new mortgage customers and also don't want to risk losing their current ones. So you may find yourself in a better position to negotiate a better rate You just looking at a quick look at the market right now, you can do that on Savings.com.au. Check out our home loan comparison hub. And yeah, you can see most home loan rates seem to be within the 6 to 7% range right now. But if you call up and speak to lenders, you may find you may be able to land a loan that starts with a 5, perhaps even with a big 4 bank. Sometimes we hear these sort of back book negotiations that people are able to have in conversations with their lenders where they get rates better than what's displayed on the website. So yeah, perhaps you could land yourself a rate starting with a 5, or maybe even a cashback of several $1,000s too, because I'm hearing that's what some lenders are offering, and we do tend to see those on offer when they're getting pretty desperate for new business. So yeah, that's my savings tip. Take advantage of the quiet mortgage market to negotiate a better deal on your mortgage.
Yeah, I like that one, Dom. I think I mentioned to you that I got a phone call from my bank last week, which was scary because I thought something must have been wrong. But they said, no, just ringing to check how things are all going and is everything
that never
fine?
happens.
And I've had quite a few mortgages in my time. And I said, are things really quiet there for you? She said, a little bit quiet. And and I think you're right. I think, they'll do what they can do to keep good mortgage payers on their books. So that's a great tip.
That's it. And did you, correct me if I'm wrong, but didn't you actually get a better rate out of that?
Yeah,
as well?
Just through a flippant offhand remark. And so there you go. Someone rang me back within the hour. A bit of a shout out to Bank of Queensland there. And that was it. It was not planned. It was literally just a little offhand comment. And there you go. They delivered. So yes, definitely worth a go.
Brilliant. Yeah, it makes me think maybe I should, at the end of this podcast recording, get on the phone with my lender and just see what they can do. Just see if there's anything that they can tempt me with. Can't hurt. Certainly can't hurt. All right, let's get into this Savings News Roundup for this week's episode. There's a few big stories to get through, Denise. You can start off with the first one.
Well, just on that theme that we were just speaking about then, there's actually some figures to back up a lot of anecdotal evidence about slowdown in the property market. And it came this week. We had the June figures from the credit reporting agency Equifax, and it's shown that home loan applications are down 14% last month, as Dom mentioned in the intro, and that's compared to the same time last year, so June 2025. And first home buyer applications fell further by 17.2% compared to the same time last year. So the analysis that Equifax supplied said the plunge, particularly in first home buyers, has effectively killed off any momentum that had been gained under that expanded 5% deposit scheme that was launched in the 1st of October last year. Things have really dried up in that market there. The June figures, of course, are the first full monthly data released after the federal government's housing tax changes. We did see, housing home loans drop in May after that, but that was only a couple of weeks after the budget. So this is a full monthly data. It's shown that yes, it's not an imagined thing. Home owners, and it wasn't just home loans; it was also all forms of credit had taken a bit of a hit. So people are really pulling their money close to their chests and holding it there. There's a lot of uncertainty in the market. But yes, it's an interesting time, and we'll see what happens. And actually our guest coming up will speak a little bit about that as well, what's happening with the property market.
Yes, certainly. No, it is interesting, particularly seeing that sharp drop in first home buyer loans, because, you think about these tax changes in the federal budget were made with first home buyers in mind, because feeling like they're getting squeezed out by property investors, maybe sort of dampen the demand in the property investor market. They'll free things up for first home buyers to some extent, but it could also be the interest rate rises. Interest rates go up. It makes things meeting those mortgage repayments pretty difficult, particularly for first home buyers. Anyone that's at the early end of their mortgage journey, those first few years are typically the hardest, because that's when you have the the most interest being charged, takes up the largest portion of your repayments. So it gets a bit easier. If you think about it. As you go through the years, typically, it doesn't always happen, but typically you should expect your salary to go up with inflation, whereas, your mortgage debt doesn't rise with inflation. So, you might find yourself, it might feel pretty hard right now meeting these mortgage repayments, but down the line, you might find it much more manageable. So hang in there. Those any first-time buyers listening that have recently gotten in, particularly if they've just gotten in with one of those 5% deposits under the scheme and battling at the moment, hang in there. But as I mentioned, of course, in the savings tip, now could be a good time to negotiate a better rate with your lender. Moving on to the next story, Australia has a new bank with global fintech company Revolut granted a banking license by the banking regulator APRA. This company, Revolut, I think we might have mentioned them on the podcast a few times. They're best known for as a travel app for foreign currency exchange and international money transfers, but they're now going to be offering savings accounts and credit cards. If you check their savings accounts on their website as of this morning, it's quite interesting because it looks like they're available under paid plans, which entail monthly fees for all but the most standard plan. So it's kind of like a subscription version of a bank. Basically, your interest rate goes up the more that you pay on your monthly plan. So I think they're currently offering 5.05% on, that's the highest rate they're offering, but that's on their highest paid plan. And it's pretty steep. It's $99.99 a month. So yeah, about $100 a month to basically get that 5.05% interest rate. So of course, if you are considering it, you'd need to weigh up how much interest you're going to be earning per month versus the fee, and then to work out, is it even worth paying those type of fees? I mean, it comes with a lot more than just the interest. Some of these accounts will come with special cards that will give you airport lounge access or reduced international travel money fees or whatever. But pretty safe to say you probably wouldn't take up the plan just for the savings account. So you can perhaps do better with your savings in a no fee, no strings account, right, Denise, as it stands?
That's what I thought. I had a look this morning just to see. I always like to see what new savings products are out there. And look, if you're already on the app and you're already subscribing, and a lot of people who travel a lot may well have Revolut as an app on their phone to make those international transactions easier. And if you've got a bit of money on your account, or you could whack it into the savings section and earn a little bit of interest on it, that might suit your purposes. But for just everyday punters looking for a good savings account, it's probably not worth paying the Revolut subscription just for that particular part of their services.
But their product offering, now that they are officially a bank, like their product offering might change pretty soon. So we'll see how things play out. Like, I don't want to be too quick to judge them already.
No, I thought that. I thought we'll give them a chance to get organised. They've just been granted the licence. I'll watch the space and be sure to report back.
No, it's certainly interesting though. And the last story, Denise, back to housing.
Another property one again. Now, this is one from this week, the Housing Industry Association, and they're sort of the industry body for registered home builders, residential builders. And they've called out changes to the self-managed super fund rules. And those were investment rules that were sort of rushed through really at the last minute to get the federal budget through Parliament as part of a deal with the Greens. Basically, as it stands, self-managed super funds, or SMSFs, are no longer allowed to take out loans to finance residential property purchases or even to build residential properties. And we saw that there were different rules in the budget concerning normal everyday investors. They clamped down hard on investors who were buying established properties, but continued their tax breaks if they were going to build new builds or buy new builds. And that's all in a bid to increase housing supply. But didn't it grant the same to SMSFs, which I guess is curious. The Housing Industry Association said there'll be, as you said, about 2,500 signed building contracts with SMSFs. There's an August 10th deadline, and the Housing Industry Association estimates those contracts will just be scrapped because it's all too hard. It's not to say that self-managed super funds can't indulge in residential property. If they can buy it outright and don't need a loan, they're still able to do that. They can also still take up commercial property. So it's just sort of wiped them out of the residential market and even building new homes. So the Housing Industry Association isn't too happy about that. They're questioning whether the government really thought all this through or just rushed that through at the last minute. So yes, we'll have to wait and see if the government moves on that. I can't see that I think they think it's a very small thing, but obviously for the self-managed super fund sector, it's not a small thing. So we'll see if there is any concessions down the line. I suspect not.
Yeah, I mean, we obviously reported on this one for Savings.com.au, and there were some interesting comments from readers. Some saying, well, you know, the Housing Industry Association obviously has a vested interest, so of course they're going to say things like that. But I mean, at the same time, they don't just make up these numbers. So they're saying, what was it? About 2,400 contracts will likely not go ahead because of this decision, and they formed that. It's estimation based on a survey that they've run of their various members, and you know, whether they have said, we won't go ahead with this construction if these buyers pull out. So this isn't an exact confirmation that these housing contracts won't go ahead. It's just sort of a little indicator of what may happen. It is interesting that, you know, some of these changes that the government have made that have had the stated interest of, you know, aiming to help first home buyers or help intergenerational equity could, you know, in a roundabout way have an opposite effect. If, for example, you know, like HIA are warning about, we see less housing supply, and you know, obviously with the property tax changes, you know, if we do see rents continue to soar, you know, it actually does just make it harder for first home buyers that are probably, you know, current renters to get into the market, because, you know, the rents are going up and there's less houses available to buy, and then maybe you just see property prices continue to increase. So yeah, I mean, time will tell, and I think, as I keep saying, probably it's getting a bit of a tired phrase now, but yeah, it's going to be good fodder for high school textbooks, economic textbooks down the line, because it's just such an interesting case study. Like, if you change this and change that, what impact does it have? And then, we can only really speculate at the moment, but in like, you know, a couple of years' time, we should be able to see the impacts of these decisions. So see how it all plays out. But yes, there are a lot of concerns particularly about this recent SMSF change, because it does seem so rushed through. And I think while the government might be saying they're making this change because of this, I think there's maybe below the surface, there might be other motivations. And, you know, if you could sort of draw some lines, I'm just thinking of that meme from that Always Sunny in Philadelphia show, where the guy's like looks all crazy and he's got all these lines and bits of string on a wall, and he's like a conspiracy theorist. But yeah, you could sort of say it's kind of awfully convenient, I guess, for the Labor Party that the Greens have come in with this request. Because Labor Party is associated with the unions, and the unions basically control the industry super funds, and industry super funds don't like SMSFs because it's obviously a competitor to them. I think we did think when Labor did come to power that I wonder if they'll do something about SMSFs and maybe ban lending, SMSF home loan lending, or even SMSFs altogether. And it's taken a few years, but now we are seeing that ban looks like it is coming in to place in early August. So yes.
Big statement, Dom. Big statement. But
I know.
Stranger things have happened in politics.
Off the deep end there, but we've got to make this podcast edgy and interesting. That's what seems to get all the listens. But yeah, anyway, I'm not saying I necessarily believe all that, but sometimes I do think it is interesting if you notice certain patterns. All right, time to talk to our guest for this week's episode. All right, time for our Dollar Dialogue segment. And this week we're talking about a new Aussie finance book that's hitting the shelves, which offers itself up as a practical guide to building long-term financial security. It's called Set for Life, and it's the third book from Aussie buyer's agent, property investor, and CEO of Oz Property Professionals, Lloyd, who I'm pleased to say joins us now. G'day, Lloyd. Welcome to the Savings Tip Jar podcast.
G'day, Dom. Really nice to be with you.
Yes, welcome back, we should say. You have been a guest many years ago on the Savings Tip Jar, so you know the drum, Lloyd. Give us your savings tip.
Well, Denise, I think my savings tip would have to be stop the Uber Eats, because that takes up quite a lot of cash, and I notice that a lot because we get that on a Friday and a Saturday night. So people often don't understand where all their money goes, and often it goes on some of that takeaway thing. So I think really curb that spending a bit on the Uber Eats on the Friday and the Saturday nights.
Yeah, absolutely. Totally agree with you that one there. Based on my own experience, before we bought this place, we lived in an area that we were basically above shops. We lived in a little apartment above shops, and there was just all these lovely restaurants below us, all different types of cuisines, and every night we'd smell all the smells, and we'd be so tempted. And obviously, with it right at our doorstep, we were getting. We were picking up, Uber Eats, actually, even though we could have just walked across and picked it up ourselves.
Yeah, you get it delivered, right? Yeah, it's so nice. The flavors just smell so nice, and I can't resist them. And we often get them even on a Thursday night after I pick up the kids from martial arts or something, and there's Indian next door. We'll just go grab some, and we're terrible like that. But I'm terrible like that, and also coffee is a bit of a I love my coffee, but I often say to people, instead of having 3 coffees a day, just buy one coffee, maybe make it another one at home or something to save money that way. Yeah,
for sure. But one way to force yourself out of it is do what I did and move to a semi-rural area where there's basically no Uber Eats available, because I'm out in the Gold Coast hinterland, and it's I think there is Uber Eats available, but from very few restaurants, and it's very, very expensive compared to just picking it up yourself. So that's definitely cut our Uber Eats budget for sure. All right, so let's get into the crux of this this chat here about your new book, Set for Life. Just firstly, what inspired you to write it, and secondly, understand you probably don't want to give too much away to prospective readers, but just for those potential readers, what's in this book and how can it help them?
Yeah, so this book is a little bit different, in fact, quite different to my first books, possibly getting by now, in the fact that this is not just about property strategies. It's really about how people can set themselves up financially, whether it's through property or whether it's through other types of investments like shares and things. I also talk about generational wealth and things like that. So it's really about being able to set yourself up so that you can live the life that you want moving forward. And I talk a lot about savings and how to save money moving forward to get yourself in a better position. I talk about what I call the Freedom Fund, which is essentially a different account to put some money into, saving 10 or 15% of your income, for example, into a different account that you can then not spend, and you can use that later on to invest, to sort of build your lifestyle and things like that. And there's something in there for everyone. So whether you're in your 20s and you're just starting out, or whether you're in your 30s, more established, you're growing a family, or in your 40s and you're looking to, maybe start to downsize and things like that, or for some people they may be buying their dream home at that stage, but then also looking to sort of invest and set themselves up for the future. So it's really looking at different strategies, different scenarios, and using a lot of case studies as well, because people love real life stories. So I've used a lot of real life stories in there, and also put myself on the chopping block as well. I've used myself as an example as well.
Yeah, I thought that's I think what made the book really readable for me is that there was a lot of the real life stuff, and I agree, people do like that. And you make the point in the book that we can't just be going out saving up our deposit, buying a house, and spending 30 years paying off our mortgage. And why can't we do that anymore?
Yeah, so the problem with that, and that comes back to what we've been taught many years ago by our forebears, so our parents, grandparents, where, you go to school, you get good grades, you get taught to go to university, and then you get a job and you work your job for 40 years so you can buy a house paid off and you can retire at the end. These days, people really want to be able to enjoy life a little bit more, and I know I certainly have wanted to be in that situation. So getting a job at 25 or 23 and then you're working and then paying off that mortgage and then trying to enjoy life when you're 65, when you're starting to, maybe feel a little bit older, having troubles with arthritis, all that sort of stuff, doesn't really work. So I feel that you need to be in a situation where you can get, you can buy your dream home as part of your strategy, but actually look at how you can actually pay it off sooner. For me, getting in and doing some investments. So if we do use property as the example there, rent vesting is a great way of getting in. So rather than struggling, and if you're living in a capital city, expensive places like Sydney, Melbourne or Brisbane, for example, rather than getting in and trying to buy that home, spending as much as you can and then being mortgaged to the hilt, it's better to get in by by a cheaper investment. You can rent where you want to live, where you're close to work, buy an investment property somewhere else, and then have the tenants essentially pay off that mortgage. But the equity in that property then will grow, so you can use that as a deposit to get into your next property. So essentially, you don't need to keep saving for a deposit for each property. And with the right strategy, you could buy 2 or 3 properties with the same amount of borrowing capacity that you might have had to spend on just that one dream home. But you got yourself in a better situation because you bought a few properties, which over time are going to get growth, and then you can leverage off them to get yourself into your dream home later on. So rather than feeling that you need to have that perfect home at 25, why not get there when you're 38? Or in your 40s, for example. So that's what I like to encourage people to do. But also, by the time you do get there, you're in a situation where you can then pay that home off quicker because you're in a much better financial position to start with.
Mm-hmm. Yeah, I did find it interesting that reading that in the book, because I'm someone that did follow the more traditional path, and it did sort of have me sort of questioning. I was like, did I make the right move there? But I also kind of thought, is that rent vesting strategy really for everyone? Like, doesn't it depend on the lifestyle situation? Because so like you said, in the book, you're advising against buying a home to live in, recommend rent vesting instead. But yeah, my partner and I, we spent the best part of 10 years saving up a deposit and investing in shares and ETFs before eventually buying our dream home just over 4 years ago. But yeah, I can't say I have too many regrets. Now we've got a couple of young kids and I see them running around the reasonably large backyard, and we've got a creek running down the back. So yeah, really in essence, what is so wrong about buying your own home before buying a property investment? Is it mainly just from a financial point of view rather than lifestyle point of view?
It's probably more financial there, because if you do buy your own home before you got any investments, you're basically maxing yourself out. So, and just using some numbers, let's say you buy yourself a home, it's going to cost you 1.5 mil. You put down your deposit, you end up with a 1.2 mil mortgage, for example. You maxed out there, and you're paying that mortgage there. So that, along with all the other cost of living expenses and stuff. People can get quite stressed out and think, this is costing me a fortune. I'm going to be paying this for the next 30 years. Now, the difference there is that for that same budget, you could get yourself a couple of good investment properties in different locations where the rent is virtually covering the mortgage. If you're getting the right property, the right strategy, and therefore you're not essentially paying a mortgage. Your tenants are paying the mortgage. Yes, you are paying rent if you're going to be rent vesting. However, you have got a growth occurring in the properties that you've got. So it's just sort of flipping things around so that later on you might be able to buy a little bit more of a substantial home. Because what I've found with people when they're trying to get into their dream home when they're really young, it says there's a limit to what they can afford, because at that age there's a limit to their incomes and how much deposit they've saved up and things like that. So if you're maxing yourself out and all you can afford is to have a small apartment, sometimes like I've met people that have a family of 4 and they're living in a 1-bedroom apartment because that's what they can afford. And those people have come to me and they've come with a bit of regret, saying, I wish I was renting and I could have just spent that money on a investment property somewhere else and have built some growth that way. So they're the things that we that I like to address from that perspective. It's just about building some wealth and then looking at how you can get there financially in the future. But it really does come down from strategy. So it's not just about getting out and buying a home or buying an investment, but it's about setting out a plan and looking at, well, where do you want to be in the next 10, 15 years with your family, with your financial goals? What do you want to achieve in terms of passive income? If you've got kids, do you need to account for school fees? Are you putting them through private schools, or even if it's public school, there's still expenses for uniforms and school excursions? Putting that all into a plan and then looking at how you're going to be able to finance that is really important, and that can often then dictate what path you should go down, whether you should be investing, whether you should be buying your own home.
I'm going to have to bring up the big elephant in the room, Lloyd, and you're a property guy. Federal government tax changes for investors, and not just property investors. They seem to be the hardest hit, but all investors have been hit with some changes out of that federal budget, particularly SMSFs, which I know you've spoken about in your book. How does this shift things? Is this still a viable path for people to take?
Yeah, well, I definitely think that property is still definitely a viable path for people to take. So we need to take a step back from that. And so the government is proposing these changes, saying that they're trying to help first home buyers get into the market by lowering the prices of property. Essentially, that's what they're trying to do, and make things more affordable. They're not really looking at the bigger picture or trying to tackle what the bigger picture is. The bigger picture is the lack of supply of property around the country. So if we look at the fact that net migration in Australia at the moment stands at over 300,000, and there's only 180,000 homes being built each year in Australia, there is still not enough supply of property to keep up with demand, because people need somewhere to live. So it doesn't matter what's happening with tax changes and all sorts of government intervention. At the end of the day, you need more property. And as well as that, there are things like the red tape around building approvals. It is hard to get DAs out of council sometimes, and then construction costs are expensive, and there's a lot of red tape around developers being able to get things approved. There's a lot of that sort of stuff that the government is not actually tackling. So they're just putting these band-aid measures on that is not really tackling the full issue. So from that perspective, regardless of tax outcomes, the properties generally around the country, especially in the right location, are still going to get good growth because they're going to be in demand. People are going to want to buy and want to live there. But one of the biggest things that I think we are going to see is an increase in rents. And now we saw that back in the mid-80s, 1985, the Hawke Keating government did the same thing. They abolished negative gearing, and then we saw rents increase over a couple of years there, and they had to then bring negative gearing back in 1987 because there was just such an a backlash from the community, but also the rents are increasing. And I think the same thing's going to happen here, because there will be inevitably less property investors buying properties for the time being, but that is just going to have the negative effect that the rents are going to get more expensive for people who are renting. So it's not going to have anything positive from that perspective.
Yeah, I did see some reports coming out recently showing that rents have started to pick up quite substantially. And I just sort of think, is this revenge of the landlords for all those tax changes that came in the federal budget? But there's also a lot of reports of this, the property market now being in a downturn and the prices are falling. Do you think we're currently in a property market downturn? And if so, how long will this downturn last? And also, is this a buying opportunity for other investors?
Yeah, 100%. So, we definitely are in a downturn in many areas. But that's not a bad thing, because property markets always go through cycles. Now, a property market cycle generally lasts from anywhere between 7 to 13 years, depending on the market and what's happening in the market. The other thing to keep in mind is there's over 15,300 suburbs in Australia. So not everything is in a downturn. So we are seeing really low auction clearance rates at the moment in Sydney. We've seen them drop a lot in Melbourne. But of course, Melbourne and Sydney are the biggest cities for auctions. So outside of that, it's not such a big thing. So we're always talking about auction clearance rates, but you don't get that all around the country. I'm also seeing in a lot of the regional markets that they are still in demand, and there's still a fair bit of growth happening there because of the price points. There are still people getting out and buying. To some extent, that's maybe slightly artificial because there has been the changes to the SMSF. So a lot of people are out there buying SMSF properties in which they need to sign a contract on before the 10th of August. So that's pushing up, demand for those type of properties as well. But so not everywhere is falling from that perspective, but we are certainly coming into a buyer's market. But that's also a good opportunity because we can look like similar things happened at the start of COVID. The market started to fall. Nobody knew what was happening. Those that got in and actually started to buy did really, really well during that period. And the same happened with the GFC in 2008. The market got soft, but those that decided to hold their properties through there and then buy ended up doing really, really well. Sometimes people make the error of thinking they need to buy when the market's booming, but that's actually the wrong time to buy because you pay too much. There's too much competition. So you need to buy when the market is softer. Is that if there are less buyers around and the market's dropping, that's when you want to get in and actually try to nab a really good opportunity.
Yes, I was thinking it's a good time to read your book, actually, with the market being a little bit slower and people not having that frenzy of thinking that they have to sign contracts straight away. So maybe it is good timing for your book after all, and just factor in that taxes, and I think you make the point in your book that governments change goalposts and rules and taxes all the time, and that's just a fact of life. So thanks very much for joining us today, Lloyd. It was a great chat, and I think, property is still to go by the sound.
Oh, look, it definitely go for me. I'm in the market for another property myself at the moment. I think it's a great opportunity, but it's been a pleasure, and thanks for having me on.
Cheers, Lloyd. Appreciate your insights. But yes, I think it was Warren Buffett that said, what did he say? Buy when others are fearful and sell when others are greedy. So I think that might be applicable in this situation. That's it. Good stuff. Thanks, Lloyd. Cheers.
Thanks, Lloyd.
That was Lloyd Edge, the CEO and founder of Oz Property Professionals and author of the new book Set for Life, which is currently available for pre-order and will soon be available in your local bookstore in the coming days. So check out that one. And that brings us to the end of another episode of the Savings Tip Jar podcast. Thank you very much for listening. If you like our content and you liked what you're hearing, please give us a 5-star review. It really makes a difference. So you can give us a 5-star rating on Spotify or Apple or whichever podcast platform you're listening on. It really does help. And if you've got any comments or questions or feedback or savings tips you want to share with us, please get in touch. Send us an email to inquiries@savings.com.au. That's inquiries with an E. And don't forget to check out savings.com.au. Check out the website and check us out on social media. We're across them all. And I guess we'll catch you next week. Goodbye.